Good evening. Today we're looking at how recent U.S. military decisions involving Venezuela and Iran were interpreted by global financial markets, and why defense spending emerged as a stabilizing factor during the initial period of uncertainty. As tensions escalated, markets responded quickly. While some equity indices experienced short-term volatility, defense-related companies, particularly those based in the United States, recorded gains. Investors viewed this as a predictable response to rising geopolitical risk rather than a signal of broader economic instability. Defense companies typically operate under long-term government contracts. These contracts are less sensitive to consumer demand. As a result, capital shifted into defense and infrastructure-linked sectors, while riskier assets temporarily lost momentum. The immediate market impact extended beyond equities. Global bond markets remained largely stable. At the same time, capital flowed toward the US dollar, which investors often treat as a safe haven currency. Supporters of the US approach argue that defense spending can act as a countercyclical economic tool. It supports industrial employment, advanced manufacturing, and supply chains that span multiple countries. From this perspective, military expenditure redistributes economic risk rather than amplifying it. However, critics emphasize the global costs. They argue that short-term market stability does not reflect long-term consequences. Prolonged military engagement can increase public debt, divert resources, and raise energy prices. For developing economies, even temporary instability in oil markets can translate into higher inflation and slower growth. In the end, the market reaction offers only an early signal. The broader global impact will depend on duration and diplomacy.